In a business, all the transactions that you have must be recorded, because the whole purpose of the business is to make a profit. And the only way that you will know what your profit is if you record every transaction. Now, this accounting cycle must be done in a specific order. So it's important that you know what is the order of the accounting cycle. So first of all, if I go into a shop, for instance, and I buy goods for cash, then they will give me a cash register roll. If I pay, for instance, with an EFT, then I still pay immediately. So it will be a bank statement, will be my source document for that purchases. Okay, so first of all, if the business sells the goods, they have to complete a source document for each transaction. After they've done all the source documents, they must record these source documents in the financial accounting record. So that means they must go and record all the different transactions in the subsidiary journal. So for instance, if we receive cash, we will record it in the cash receipts journal. If we pay money, we will record it in the cash payments journal. So we have several journals that we record the transactions. Now all the entries were recorded in the subsidiary journal so that we can see exactly how much money did we receive and how much money did we pay out. But after we've completed the subsidiary journals, we have to post the entries. So all the entries in these two journals must now be taken to accounts in the general ledger. So it means that I will go and debit one account and I will credit another account. So for instance, for this transaction, we received money, so we will debit the bank and we will credit, for instance, sales or the income services rendered. If we sell goods, we have to do a second entry for cost of sales and for trading stock. So it means that I have to record these entries in the general ledger, and for every entry I have to record the entry in one account on the debit side and another account on the credit side. Then at the end of the month, I want to make sure that I recorded all the entries with a debit and a credit. So that's why I complete a trial balance. So I take the debit balances and I put it on the debit side of the trial balance, and the credit balances will go on the credit side. So if I didn't make any mistakes when I recorded the debits and credits, the debit side and the credit side of the trial balance will be correct. Now, what is the whole purpose of the business? It is to know what is my profits. So I take this information in the trial balance and I record financial statements. So the one statement that I will record is the income statement. In the income statement, I show all my income and expenses so that I can work out what is my net profit. And then I also record entries in the balance sheet. So my second financial statement will be the balance sheet, and in the balance sheet I will record all the assets, liabilities and equity. So the purpose of the income statement is to record whether we made a profit or a loss, and we can determine what is the actual profit or loss. In the balance sheet, we record the financial position of the business on the last day of the financial year, showing the balances of assets, equity and liabilities in the ledger accounts on the last day of the financial year. Now, what do we want to do with this financial statements. There's a lot of people who are interested in the financial statements because they have to make decisions according to the information. So the business, for instance, wants to see, is it worth carrying on with this business? The owner wants to know if the profit is big enough. The bank is interested because they want to see if you will be able to pay the loan and the bank overdraft. The creditors are interested because they want to see whether you will be able to pay your creditors in the future. The trade unions are interested because they want to see if they can ask for higher salaries for the employees. So there's a lot of people who are interested looking at these financial statements. So what the business does last, they take this income statement and they analyze every transaction in the income statement to determine what went wrong. Why is the expenses higher than it was the previous year? Why is the income lower than the previous year? So they compare this income statement with the previous year's income statement to see, did the business improve or not? They also take this income statement and they compare it to similar businesses to see how does their profit compare with the profits that other businesses made. For instance, Checkers and Pick n Pay sell the same type of products, so they will compare their financial statements. The balance sheet they will take and they will say, okay, how did my assets and my liabilities improve or decrease since the previous year to the current year? What must I do to improve this situation? So in the income statement, if the profit is not good enough, they must think out methods that they can take to make a bigger profit. So for instance, they can increase the profit percentage that they make. If there's expenses that's extraordinarily high, they must get measures to reduce those expenses. In the balance sheet, they must look at the different entries in the balance sheet and decide, must we, for instance, have money on a fixed deposit while we have a bank overdraft? Because the interest that we receive on a fixed deposit is much lower than the interest that we will have to pay on a bank overdraft. So that means all these people who are interested in the financial statements is going to take this financial statements and they're going to analyze every single entry on the financial statements and interpret it to decide how can they improve the situation and is it worthwhile carrying on with the business.